on Australia's Business Channel. This is Debt to Equity.
Talk about the funds that you've got specifically. It's a range of 7 funds. I mentioned the Chatswood one as having kicked off, if you like. But tell me a little bit more about these 7 funds and how it works and how it's different to the other property.
Yeah, we have 7 funds, and basically they are development funds and investment funds. So the development funds are for the construction and development of multi-unit residential development. And once the construction is complete, they'll turn into an investment. We have currently 2 under construction at the moment. We have 1 long-term sort of retail investment. We have 2 funds that are in the planning stage, so they haven't been open to investors yet. However, we have a short list of investors ready to take that on.
Particularly because the other ones have been oversubscribed.
Yes, exactly. So we're in a tough spot. We're trying to fund the sites, and unfortunately we have to keep turning investors away. I guess it's a good problem to have, but we're very conservative in when we look for sites and when we look for our projects. We're very conservative in our figures, and we have to be all the boxes, and there's a lot of boxes that have to be ticked for us to go on with the project. One other important thing is why we're different to the other funds, they'll just take the investors' money, take it, and they'll find somewhere to put it. We actually make sure that our investors' capital is directly attached to the building that they're investing in. So the investor always knows where their money is, which building it is, or which development that it's attached to. So there's no confusion with these complex debt structures, complex financial engineering, which is, as we just discussed, the Centros, the West Points, Alcos, etc., have really caused shareholders to lose thousands and hundreds and thousands and millions of dollars. So
so you buy directly into the fund, into the property.
Correct.
And I suppose it's a case of just buying 1 share in 1 property, or alternatively, as an investor, you could actually buy the unit itself. This is an alternative
Correct.
to that.
So we give you 2 options. The way it's been derived is that when I originally looked at bringing a fund together, is I looked at the models that existed, and it was so complex that I couldn't understand most of them. I said, look, if I don't understand this, there's no way I can promote this sort of fund. So I said, I'm going to invest something that I can understand. It's simple. It's not. I'm a simple guy, so I'd like to keep things very simple. So I said, okay, well, the best way to identify an easy fund is to directly attach the shareholders' wealth to the property. So I didn't want to spread the risk into a lot of other properties. I just wanted to focus on one property and spread the risk amongst the investors, but not on different locations, different properties, different structures, and so on. So it's their shares are directly attached to bricks and mortar of that property.
Which I suppose acts as a transparency.
Very simple
clause.
to understand. It's a very uncomplicated investment strategy.